about later on. All right, so learning objective 3 actually introduces you to 4 financial statements that are very important. However, we sort of break them apart. The ones that we focus on in financial accounting are the income statement, the retained earnings statement, and the balance sheet, the 3 that are listed first. The cash flow statement is something you'll do in more detail in managerial accounting. And I think that's because it's just a little bit more complex of a statement. And so it's okay to kind of put it off. They introduce it here because it is a very important financial statement, but you actually don't have to do any of it until you get to the next level. Amen. Hallelujah. But the first 3 will give you enough work to do. The income statement, retained earnings statement, and balance sheet will give you enough work to do. So no worries on that. So one of the things to sort of understand is the order that's listed here for the 3 that we're going to be focusing on is very important. The income statement is always the first statement that is prepared because it's the only financial statement that can answer the owner's question, did we make a profit or not? Okay. And otherwise, I mean, as an owner, you're most interested in whether you made a profit during a period of time or not. So the only statement that provides that answer is the income statement. The income statement will tell you if you made a profit or you had a loss for a period of time. Now, the period of time is very important because income statements measure things on a monthly basis. They also measure things on a quarterly basis. And we mean quarterly, we mean a quarter of a year. So since there's 12 months in a year, a quarter of that would be 3 months. So a 3-month period of time is called a quarter. And then, of course, income statements are measured monthly, quarterly, and the longest we'll see is 1 year, a full 12-month period of time. So income statements measure a profit or a loss for that period of time, either a month, a quarter, or a year. And it's always, always, always the very first statement that's done, that's prepared. Okay. When we're actually doing it, and you'll be learning how to do that, that's part of the chapter, is learning how to do a basic income statement. Income statements show whether we have, what type of revenue we made. Now, revenue is done because all companies have something to sell, right? There's 2 things that you can sell as a company. You can sell physical goods, products, like Walmart, it sells physical products. You walk into a Walmart, you're going to be coming out with a whole bunch of crap, right? Or companies also can sell services. And a service is when you pay someone to do work for you. And so it could be a house cleaning service, some company that comes in and cleans your house. They're actually cleaning your house. They're doing that work for you and you pay them for that. That's their revenue. Or you could go to a lawyer for legal advice. That's a service as well. They might be looking at a contract you might need to sign, explaining it to you, suggesting improvements or pitfalls before you sign it. That type of work is a service. You're paying someone to do that. That's what dentists and doctors do, lawyers and accountants, consultants, that's what they do. So when you pay someone for their work, that's service. Some businesses, of course, do both. They sell you goods and provide you services. So for example, if you went to get your tires on your car changed, you're going to be paying the company to remove the tires that you have on the car. So you're paying them to take stuff away. You're also paying them to put the new tires on, align them, fill them up with air, etc. That is a service that they're providing. But you're also buying the tire. The tire is a good. So they're providing a sale of a good as well. So in those cases, and there's some companies that do both. You might go into a hair salon. You'll pay someone to style your hair. That's a service, but you might also be buying a bunch of product on the way out. So that's a sale. So all companies have revenue. It's about what they sell. And they don't have to sell one thing or the other. They can sell a bunch of different things. But we have to understand that revenue is where everything starts in accounting. Everything exists because companies or organizations sell something. Okay, and so if they're selling something, they're going to be getting revenue for whatever they're selling. Of course, they have to incur a bunch of costs to provide that. So Walmart has to, buy all of the goods before they sell them to you. They have to pay the employees. They have to pay for, the electric and other types of things like this. So in other words, they have to incur expenses in order to be able to sell you what they sell. Same thing at a lawyer's office or a doctor's office. They have to be paying rent. They got to pay employees or other types of things that they have to do, costs that they have to incur, so they can provide services to the customers that they have. So those are called expenses. And that's basically what an income statement tells us all about. It compares the revenues to the expenses. And the goal for all companies is to have more revenue than the expenses. Okay, and that's because, as you'll see on the income statement shown here, revenues are listed first. This is what they sell to customers. That's what's shown. Expenses are listed next because that's how much of the how much it costs to provide this service. The difference is the profit. Profits occur when companies sell more than it costs them to sell it in a given period of time. Now, this is an income statement. Income statements are measured by periods of time. This particular income statement measures the month of October, ending October 31st. So that means from October the 1st through October 31st, this particular company, which is a fictitious company in your book, Sierra Corporation does tours, like hiking tours of the Sierra Nevada region. I don't know if you read through that in your book or you remember, but that's basically what Sierra Corporation does. So it provides a service. When you pay someone to give you a tour, you're paying someone to provide a service for you. Okay, and so if you notice here, the revenue account that's listed is something called service revenue, because they are, in this case, this company is simply providing tours for the payment from customers. So that's their service revenue. I'm a customer. I go to Sierra Corporation. I say, look, I'd like to get on your 1 o'clock tour around Lake Tahoe. I understand that it's $30. Here's my $30 for the tour. Well, the $30 that the customer paid for the tour is the revenue for the company, is the service revenue for the company. That's how it all works. Anytime you go shopping and you pay for something, whatever price you're paying is the revenue to the company who's selling it to you. So even if you just go into Dunkin' Donuts and grabbing a cup of coffee, you put down a couple of dollars, $2, $3 for whatever it is you purchased, that's their revenue. That's their revenue. So revenue of a company is reflected in the prices that the customer is paying them. And that's an important concept to know. Another important concept is revenue is a type of an account, but service revenue is a specific name of an account. And if you want to know the root word of accounting, it's account. So if you want to know more about accounting and do well in accounting, you need to get to know the accounts, okay? Service revenue is a specific account. It tells us how much money the company was provided by the customers for giving them a service, in this case, a tour. Expenses is a general account. Specific accounts are listed underneath. So a salaries and wages expense tells us that in the month of October, Sierra Corporation paid $5,200 to their employees to do the tours, to do the work that needed to get done in October. It's an expense because they had to spend that particular money in order to provide the tour to the customer. Without expending that type of money, there'd be no tours. There'd be nobody to give a tour. So these are expenses are really about costs to the company that they need to do to raise or to sell whatever they're selling, right, to customers. Rent expense is a specific expense account. It tells us how much this company paid in the month of October for rent. Now, this might surprise you, but most companies don't own their own buildings. Whether some companies do, Walmart owns their own buildings, Wendy's, McDonald's, they tend to own their own buildings. But the vast majority of businesses out there rent. So, and I know everyone here and in the class, I'm sure you've been to a mall. May not be the Poughkeepsie Galleria, but you've been to a mall. If you haven't been there, you're not missing too much. But anyway, you've been to a mall. The mall is owned by a real estate company that rents out all that space to those businesses. So every single business in a mall is paying rent every month to be there. So that means every month they will have a rent expense because they have to pay the rent in order for them to have the store there to open up to customers. So it's a necessary cost to do business. No store, no customers to come in the store. So the rent expense is a specific type of an expense account. Salaries and wages expense is a specific type of expense account. So there are general accounts. Revenues are general accounts. Expenses are general accounts. But we have to know the specific accounts and what they mean. Okay. So one of the things that Learning Objective 2 introduced you to were some of the names of the specific accounts. Learning Objective 3 organizes these accounts on the financial statements they belong in. Notice that the income statement has revenue and expenses. This is the only statement that'll show revenue and expenses. Revenue and expenses don't belong on any other financial statement. They only belong on the income statement. They also belong on the income statement in this order. Revenues are always listed first. Expenses are always listed last. Notice that here we have the total expenses of $7,740 and a total amount of revenue for $10,600. Now the 7740 number is these 6 expenses added together. Okay. Well, if you took in $10,600 from customers in revenue, and it only cost you $7,740 to run your business in October, the difference is your profit. Net income is the formal term that we use for profit, but it means this, it's the exact same word. So net income and profit are interchangeable words. Not only is net income and profit interchangeable words, earnings, the word earnings, which you'll see on the next statement, means the same thing. Earnings, profit, net income, all mean the exact same thing, okay? So just know that there are some interchangeable words that you need to become familiar with in order to sort of understand the statement. But the net income is the profit. It means that the revenue for the period was bigger than the expenses, and the remaining revenue is the profit of the company. So here's a question. Who owns the profit? So here, Sierra Corporation just calculated in October, it had a profit of $2,860. Okay, that's terrific. Who owns the profit of the company?
Shareholders?
Yeah, the owners. The owners own the profit of a company. So whether it's a sole proprietorship with only one owner and that company has a profit, it belongs all to that one owner. Here, because we're looking at it from a corporate perspective, the owners of the corporation are called shareholders or stockholders. Again, shares of ownership and stock mean it's the same word, means the same thing. They are the ones who own the profit. Now, if you were an owner of a business and it made a profit, what would you want to do with that profit? Just grab it and go?
Invest it.
Okay, so a lot of people would say, let's reinvest it, but a lot of people don't know what that means. So let's talk about it. Okay, so first thing we have to know of, if we're going to reinvest the profit, now this is the income statement just in miniature form here. So again, the profit for October, $2,860. Well, when you say let's reinvest it in the company, we're going to have to decide how much of these profits, again, profit, net income, earnings, they all mean the same thing. Earnings, profit, net income, all the same word. It's interchangeable, okay? We have to see, okay, if we made $2,860, how much of this money is going to be kept in the company for reinvestment? Retained means to keep in. Earnings means profit. So retained earnings simply means how much of the profit is being kept in the company for reinvestment. Well, what else can happen to the profit? Well, what else can happen to the profit is some of it is shared with the owners in the form of a dividend. A dividend is simply when a corporation shares a portion of the profits with the actual owners. The problem is the owners are separate people than the corporation. So this money is going out of the corporation to the owner's personal account. It's not staying in the corporation, it's going out. And so notice how in the retained earnings statement, once the profit is accounted for, they subtract out any of that profit that's going out of the company in the form of a dividend. The remaining portion of the profit is being kept in the company. Remember, retained means to keep in. Earnings is profit or net income. So the amount of the net income that is being retained, the amount of the profit that's being kept in the company is the difference between what it earned that month, which in this case is the net income, less the dividends, the amount of it that went to the owner's personal pockets. Okay, that goes to your, so if you're a stockholder in Disney and Disney has earnings, and they say, we're going to share some of this earnings with the stockholders, you got a dividend. That dividend is going into your personal pocket. It's not staying in the company. So it's not retained in the company. So again, the word retained is specific to the corporation. Okay. And so what is being retained of the profits of the company is really what the retained earnings statement is. It's a very simple statement because all it's telling us is if the company started with any retained earnings. Now, Sierra Corporation is brand new, so it has 0 retained earnings at the beginning of the month because it just started in October. We just calculated how much profit it made in October, so that gets added. We were told here that $500 of that profit was sent outside of the company to the owners in the form of a dividend, so that has to be removed, so taken out. What's left is $2,360. $2,360 of the $2,860 is retained in the company, kept in. Just as one of you, Juanita, might have said, to be reinvested in the company. So I want you to notice, yes?
Yes, that's what I said.
Thank you. I want you to notice another thing on these two financial statements. The income statement and the retained earnings statement cover the exact same period of time. And that's because you can't have a retained earnings statement without first calculating the profit, right? So you have to calculate the profit of the company before you can do a retained earnings statement. So income statements are always done first. Retained earnings statements are always done second. And they're always for the same period of time. Because the income statement tells us if we're profitable during that, in this case, this month, and the retained earnings statement tells us how much of the profit has been retained. Okay. And so these two statements always go together for the exact same period of time. And that's a very important point I wanted to make sure you got. Now, retained earnings, like I said, who owns the profit? The owners own the profit. So retained earnings now becomes a stockholders' equity account. It shows two stockholders' equity accounts on the balance sheet that you need to be familiar with. They're the only two accounts that you're going to see in this class up until we get through chapter 11. Common stock is ownership. Now, you know, when you start a business, you've got to put money into that business to start it. It's not going to start by itself, and it needs cash to start. So you owners put money in, cash into the business. They get back the shares of ownership, which is what we call common stock. Stock and shares of ownership being the same thing, interchangeable term, right? And so as soon as the owners put cash into the business, which you need to do to start the business, they're taking their shares of ownership at that time. So common stock is always going to be the first stockholders' equity account because it shows how much the owners put into the business to start it. Retained earnings is a different account because it's the profits of the company, which means the company has to be functioning for a time before it's profitable. No company is really profitable up front. It took Amazon 8 years to earn a profit. Of course, now it's very profitable. A lot of companies take Tesla, even though it's a high price stock, has problems with profitability. It's not stable in terms of its profits. It's got more losses than it's profitable. That's different than Apple, which has been profitable year after year after year for the last, I'd say, 10, 15 years. And so, it's a little bit different. But the profits of the company are the owners. It's the owner's property. They own the profits. So retained earnings is simply the retained profit. And that's why it's a stockholders' equity account. So again, common stock happens at the very beginning. Owners put cash in the company, they get shares of ownership. That's what common stock is. After the company runs a bit and it has earnings, then, yes, Tesla has its issues. Then the question is who owns the profits? The owners do. And that's why it's here under stockholders' equity. Okay. Let me go to the general balance. Now notice the balance sheet is different in the title because a balance sheet is only a snapshot of the day. So it's almost like I would say it's exactly like a financial selfie, okay, of the day. You've all taken selfies. Don't tell me you haven't. I don't believe you. And so this is basically a financial selfie of a corporation on a particular day. It tells us as of that day, right, what the assets of the company are. Now, assets are resources that the company uses for two purposes. One, they have to pay their bills. Two, they have to have long-term assets to make money. So in other words, think about a Dunkin' Donuts that continues to put up these kiosks at different colleges, at different gas stations. Why are they doing that? Well, those are assets of the company that they're deploying. They're investing those into those assets. And that's what investing really means. When you want to have those earnings invested in the company, well, you want to put them back into the company so they can sell more stuff. So for a company like Dunkin' Donuts that wants to sell more coffee and donuts, I guess, or other baked goods they have, they need more assets to do that. They need more equipment, they need more stores, they need more of this. So that's how we reinvest the profits. We reinvest the profits in almost guaranteeing us that we're going to be selling more stuff. So for example, let's say I own a pizzeria. And of course, if you don't know, my main product is pizza, but that's basically it. So if I had a profit, what would I want to do with that profit? Well, okay, I'd like to retain as much of it as possible to reinvest in my company. How would I reinvest in my company if I'm a pizzeria? Open question. Open question. How would I reinvest my money if I owned a pizzeria and I made a profit? How would you do it? Oh, we're on a commercial break. I'm sorry. Okay, so let me answer for you since either you're all checked out, in which case, I don't know, maybe I'm a good cure for insomnia. But, maybe it's something different. If I wanted to, I got a couple of chats. Amen, hallelujah. Upgrade appliances, yes. You don't want to, adding food to the menu wouldn't be an investment. It could pay off, but it's not, it wouldn't be the type of asset that we would want to do. But certainly upgrading appliances would definitely. I wouldn't necessarily buy more product because buying more product doesn't mean guaranteed I'm selling it. But if I upgraded my appliances, so let's say I'm a pizzeria and the pizza oven that I have only can cook or bake 6 pizzas at a time in a 10-minute period. If I perhaps bought a new pizza oven, more efficient, and now I can actually cook twice as many pizzas in 10 minutes as I used to, then that would be an investment in an asset that would provide me with more revenue. Because if I can cook twice as many pizzas in the same 10-minute period, I can sell twice as many pizzas. And that's really how you judge whether it's an investing activity. Marketing is never an investing activity. Marketing, it's a good idea, but it's an expense. It's never an asset. So if I buy, and this is actually kind of the funny thing about if you ask advertising executives, one of the things that they'll lament is they'll say, look, we know we're wasting half of our advertising dollars. We just couldn't tell you which half. And they joke about it that way, but it's true because it's so hard to measure from a marketing perspective whether this particular advertising campaign brought in new customers. It's so very difficult to link those two. But if I have a pizza oven that can cook twice as many pizzas and I'm selling twice as many pizzas, that is a straight line. That asset is producing more pizza, selling more pizza for me. I'm having more revenue and thus more profit. What if I invested in a delivery van for my pizzeria? Well, that would also be a good asset to purchase. That would also be a good reinvesting activity because now I know most people like pizza or pizza-like products, but a lot of people just don't want to go out of the house and come to my store. But if I delivered directly to them, they would be buying my pizza. And so definitely the relationship of a delivery truck with selling more pizza would mean that it's a good investment in the business. Even if I decided to add a drive-through in my pizzeria, so I'm throwing slices out the side of the building now, well, that also might mean, because drive-throughs tend to be very busy. A lot of people don't want to get out of their car, but they'll stop at a drive-through for a coffee or a burger or other types of things. You kind of know the deal. Well, if that happens with my pizzeria, that would also be an investment activity. So just understand that when we're talking about investing activities with these retained earnings, we're really talking about buying assets that are going to help me sell more stuff, whatever type of stuff I sell. Okay. So if I'm selling coffee at Dunkin' Donuts, more kiosks would mean more coffee sales. Again, in my pizzeria, some assets are going to allow me to sell more pizza. That's the type of reinvesting activity that I want because it can be directly related to selling my stuff. Okay, we can't draw the same line with marketing or advertising. Marketing and advertising are expenses. Okay, they're not assets. And so when we reinvest, we're reinvesting in assets. Okay. So these are 5 specific types of asset accounts. And it's very important to understand that there are broad categories of accounts like assets, liabilities, stockholders' equity. These are types of accounts. But then there's specific accounts. And you have to know the specific accounts. If you want to know about accounting, the root word of accounting is account. So understanding the accounts is a key to understanding accounting. So understand what these accounts mean are very, very important. And of course, you may not get it all up front, but it's important that you keep at it. So cash basically is all of the cash the company has. It tends to be basically the total of their bank accounts. Okay, so I had a corporation, I would have a bank, I'd be having a checking and maybe a savings or other type of account there. Whatever I have there, that's my cash, and that's what's on the balance sheet. Okay, accounts receivable, for example, is businesses will often sell to other businesses and get paid later. In other words, I'm gonna sell you these tours and I'll wait to receive your money later on. That's an accounts receivable. Anytime a business is waiting to receive money for a service that they've already done for somebody is an account receivable. Okay. Supplies and prepaid insurance, all of these are relatively short, what we call short-term assets. In chapter 2, you're going to be learning specifics about how we classify assets. Equipment is something that's long-term. Any type of equipment is something the business is going to be using for a number of years. And the difference between short-term and long-term in accounting is simply 1 year. If it's less than a year, if it's going to be used within a year, it's short-term. If it's going to be used well after a year, long-term. That's how we split it up. Liabilities are anything that we owe, right? Anything that we owe. That's a general type of account. These are 5 specific liability accounts that are listed. I'm just going to go through a couple of them. So the difference between a note payable and accounts payable. So a note in accounting is a loan. Anytime you see the word note, it's a loan. How do you know it's a loan? There's an interest rate and a due date. And in accounting, notes, a lot of us think about loans saying, oh, I got a loan, I have a monthly payment. That's not how it works in business. A note payable, basically they give you the loan. Let's say they give you a loan today. 3 months from today, at the end of December, the note is due with interest. No payments between now and that time. It's just the note is due, and that's a note payable in a corporation. So it's a loan with an interest rate and a due date. Everything is due on the due date. The loan and the interest is all due on the due date. That's a note payable. An account payable is simply any bill that's due within 30 days. So for example, if you have an apartment or an office, you're going to get a bill from the Central Hudson for electric or gas or both. You get that bill, you open it up, oh shit, now I owe $100 to Central Hudson. Well, guess what? Now you have an accounts payable. There's no interest on that, and it's certainly not a debt. It's a bill that you owe because you've already used the electric. And so basically that's an accounts payable. I do want to bring up this, I think I brought it up in the video that I posted of a previous lecture, but it's very important that you understand this liability called unearned revenue. Unearned revenue is simply when the customers pay up front. And it's a liability because you owe the customer for what they paid for. And this is a lot more common than people realize. Let's just take a very basic thing. You decide to buy a vacation to go to you're going to Disney. So you've paid for airline tickets, you've paid for hotels at Disney, and you paid for 3-day passes at Disney parks. It's a long weekend you're going for. And all that money is paid up front because you got a good deal. So how does the company that took your money account for this? Well, the airline owes you a flight to Florida. So it's unearned revenue, unearned ticket revenue for the airline. The hotel down at Disneyland owes you some nights at the hotel. So that's unearned revenue as well because it's a liability. They owe you that. And those 3-day theme park passes that you paid up front for is also unearned revenue because they owe you 3 days on a Disney park. So it's a very, very important type of account because it means the customer has paid up front and you owe the customer for what they paid for. That's different than what's on the income statement. What's on the income statement, you've already delivered. So if I were to hop on a plane right now to travel to Florida, that means that as soon as I pay for it, I'm hopping on the plane. So that's their revenue. It would be on the income statement because revenue has been earned. Unearned revenue is a liability because you haven't delivered it yet. You haven't earned the money yet that the customer has given you. So those are very, very important clarifications. I brought that up, I think, in the older video, but I wanted to make sure you had this down. So I want you to notice too that it's a balance sheet. So what's going to balance? Well, the total amount of your assets needs to balance with the total amount of the liabilities and stockholders' equity. Notice the total liabilities are listed here. Total stockholders' equity is listed. Those two added together give you the $21,910, which is exactly the amount of your total assets. See, total assets are listed, total liabilities, total stockholders' equity. So a balance sheet is a balance sheet because the assets equal liabilities and stockholders' equity. This particular formula of assets equals liabilities and stockholders' equity is a very important formula. It's called the accounting equation. It's also called the balance sheet formula. But nonetheless, it is a very, very important formula that you need to know. Okay. All right. So I'm going to stop there. I'm also going to stop our recording and ask